Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, I thought I'd do is provide you with some insights related to the financing process. I'm actually working with a few clients right now that are determining whether or not to go with certain banks based on the terms that they provided to them. And so what I thought I'd do is provide you with 5 key insights to consider as you're going through the process of seeking commercial financing. But before we get into this video, I would really appreciate if you'd like, share, and subscribe to this channel. It really helps with the YouTube algorithm and spreading this message to many, many more people. So let's go ahead and dive in. So the first term to consider as you're working through determining which financing option to go with is your interest rate. This is generally the one that everyone talks about. It's like, what's the interest rate on this loan? And for good reason. I think the biggest reason why is because it dictates how much interest you're going to have to pay over the life of the loan. Just as an example, if you take $1 million loan at a 4% interest rate versus a 5% interest rate, over the life of that loan, let's say it's 20 years, you're going to save almost $130,000 in interest payments if you go with the 4% interest rate versus the 5% interest rate. So it does make a huge impact on your decision-making process. Now, as you're looking at that interest rate, understand there may be some other things that go into play. So for example, some banks will show a great interest rate, but in order to get that interest rate, you have to do point buybacks, meaning that you're going to have to front some of the money up front for interest payments in order to achieve that lower interest rate. So you got to understand what your out-of-pocket costs in order to be able to achieve that interest rate before you decide, okay, this bank's the best one to go with because of that interest rate. And if, let's say, that bank does offer the lowest interest rate, maybe their other terms aren't as competitive. So one thing I do recommend that you do is don't just look at the interest rate and say, okay, that's the best loan for me. You got to take into consideration all other aspects of the loan prior to pulling the trigger on the actual loan financing option. So number one thing to consider is the interest rate, because it is a very important component of a loan package. Number 2 is the term. Now you may be asking, what is a term? Generally speaking, a term is how long is that interest rate going to be fixed for? In residential real estate, the term of a loan is as long as the amortization period is. So if you buy a house on a 30-year note, it's going to have a term of 30 years, meaning that the interest rate is going to be fixed over that period of time. In commercial real estate, that's not the case. Generally speaking, terms range from 5 years up to 15, maybe 20 years if you're lucky. But most of the time, it's usually 5 to 10 years. So what usually happens is at the end of that 5-year term, that loan either comes due in a balloon payment, meaning you pay the remaining balance in the loan, or it starts to float, meaning that based on what the interest rates are at that time, it moves every 6 months to a year. And generally speaking, it would fix to a particular index, generally LIBOR, which is a type of index out there. And I'm not going to go into too much detail on what that is. This is not a finance lesson. However, just know that the term is how long is the interest rate going to be fixed for? And then after that time, it either comes due as a balloon payment or starts floating as an interest rate. So generally speaking, as a person who's receiving a loan, having a longer term can be beneficial because you get to fix in a lower interest rate. And given the interest rate environment right now, where we're at historically low interest rates, it's pretty likely that interest rates are going to increase over the next 5 to 10 years. So why not lock in that interest rate for a longer period of time, even if you have to pay a little bit more to be able to achieve that longer term, it may be beneficial. So number 2 thing to consider is the term. How long is that interest rate fixed for? And then at the end of that term, what happens? Is it a balloon payment or does it start floating with an index? And all this is negotiable most of the time. Number 3 thing to consider is the amortization period. Now, a lot of you may be asking, what is amortization? It's how long are your payments spread out over? With residential real estate, you're usually looking at a 30-year amortization period, meaning that all your payments and principal interest payments are spread over 30 years. In commercial real estate, it's generally not the case. Most of the time, it's either 15 to 25 years is what they're spread over. Now, the reason why amortization period is an important consideration is because the longer the amortization period, the lower your mortgage payment is going to be. That's because those payments are spread over a longer period of time, thus lowering your mortgage payment. This can be beneficial from a cash flow perspective because your mortgage payment is going to be lower than maybe what your rent's coming in. Therefore, you have a better spread to achieve from a cash flow perspective. Also, however, though, is that you're going to be paying more interest over the life of the loan because you're spreading those payments over a longer period of time. Thus, your interest payments are probably going to be higher. The sum of your interest payments are going to be higher over that 25-year period. So as you're considering what your approach is going to be, do you prefer the cash flow produced by the property as an option, or are you someone who just wants to pay off the debt as quickly as possible? If that's the case, you may opt for a lower amortization period and just throw as much money as at the loan as possible in order to get it paid off as quickly as possible. Now, if you like the cash flow produced by the property, maybe having a longer amortization period is more beneficial because you're able to keep the spread from the rents that are coming in versus the mortgage payment going out. So number three thing to consider is going to be your amortization period. Number four thing to consider in a loan package is going to be your loan to value versus your debt service coverage ratio. So let's unpack each of those so you can kind of get a feeling for what those are. Your loan to value ratio is the ratio between your loan amount and the value of the property. And this is generally used with owner occupied real estate. So what this means is that let's say that you buy $1 million building. Most of the time banks are going to require you to put up at least 20% down on the property. So you're going to have to come to the table with $200,000 to buy that $1 million building. So your loan to value ratio is going to be $800,000 divided by the $1 million value of that building. So your loan to value is going to be 80%. This, like I said, this is generally used in owner occupied real estate because there's no income being produced by the property. Now, in the scenario where the debt service coverage ratio comes into play, which is the other variable in the scenario, is the debt service coverage ratio is a ratio between the income produced from the property or the total NOI, the net operating income of the property, divided by the debt service or what your yearly mortgage payment's going to be. So for example, let's say that your mortgage payments for a year are $100,000 and the bank has a 1.25 debt service coverage ratio requirement. That means the total NOI of that building's got to be at least $125,000 in order for the bank to loan you the money. So what the banks usually do, especially in investment real estate, is to look at both. They look at the loan to value ratio and the debt service coverage ratio, and they both have minimum requirements. So loan to value ratio may be 20% and the debt service coverage ratio may be 1.25. Now let's say that this property is a cash cow and it produces a ton of income. So maybe your debt service coverage ratio is 1.5 as a ratio. Well, they're not going to give you a loan based on that 1.5% ratio. They're going to give you a loan based on the lower of the two. So in the scenario where you have a cash cow producing 1.5 debt service coverage ratio, they may only give you an 80-20 loan because that's their minimum requirement and they take the lower of the two. So it can be kind of complicated in determining what the loan amount is going to be for your particular loan. But as long as you understand that the loan to value ratio is a relationship between the value of the property and the loan you ultimately have, and then the debt service coverage ratio is a relationship between your total NOI divided by your total yearly debt service, at least you have an understanding as you go into the negotiation process of how you're going to be able to get the best loan that's right for you. So number four thing to consider is your loan to value ratio and your debt service coverage ratio. And most banks are going to have preset amounts that they go with. And then finally, number five thing to consider is a prepayment penalty. Now, what is a prepayment penalty? Prepayment penalties generally are when a penalty associated with paying your loan off early. Now, the reason why banks do this is because there's a lot of costs associated with issuing a loan. There's sourcing of the loan. There's loan origination fees. There's various other things that go into putting a loan on the table. And not only that, but as the loan is issued to you, the bank is making money from interest payments and whatever else. So in order to disincentivize you from refinancing and going with another bank or whatever else, they attribute some sort of prepayment penalty with the loan. This could be in the form of a percentage of the total loan amount. So I know some banks in town, they do like, let's say a 2% flat prepayment penalty for the loan amount. So if you take out a $1 million loan and then you refinance 2 years later, 3 years later, you have to pay 2% of the total original loan amount, which would be about $20,000 in a penalty. There's also banks out there that do a graduated prepayment penalty, which would be like 5% the first year, 4% the second year, 3% the third year, 2% the fourth year, etc. Right? It's a graduated. It goes down as the years progress. And the reason, as I said, for this is to dissuade you from refinancing and essentially not putting their money to work. So in order to negotiate this a little bit, because it is 100% negotiable, is if you have a strong financial situation, it may be worthwhile, in particular if you want to pay off your loan early, to be able to, make sure that you're able to do that without achieving or without receiving some sort of penalty for just paying off your loan as quickly as possible. So number 5 thing to consider is to ask what the prepayment penalties are. And if there are any associated with that loan, just make sure to get them taken care of in some capacity, whether you only have it the first couple of years, or maybe you get them lowered to as low as possible. So it gives you the opportunity to either A, refinance if there's another opportunity available in the coming years, or if you're someone who really wants to pay off your loan as quickly as possible, it gives you that opportunity as well. So I know that was a ton of information. I hope that you gained some value from this video. If you did, feel free to like, share, and subscribe to this channel. I love providing awesome, engaging content related to commercial real estate. If you're in the market to buy, lease, or sell commercial property, feel free to reach out to me. My number is 502-536-7315, or you can reach me via email at Raphael@CREGroup.com. All right, we'll see you guys next week. Bye.